Hello friends, welcome you all. Today in this lecture I am going to teach you the components and limitations of DuPont analysis. In the previous lecture we have discussed about what is DuPont analysis, its origin and its calculation. Also we have discussed different formulas and how to calculate DuPont analysis, and with the example of two companies we have analyzed it, and also we have discussed about the return on equity and how DuPont analysis decomposes the uh, return on equity, and which drivers are bringing effect or have the effect on return on equity. We have discussed all these things in the previous lecture. So I'm just taking the review of previous lecture that DuPont analysis is a framework for analyzing fundamental performance, and it is popularized by the DuPont Corporation, that is chemical company in the US market. DuPont analysis is useful technique used to decompose the different drivers of return on equity, and it decomposes return on equity and allows investor to focus on the key metrics of financial performance and individually to identify strength and weaknesses. We have discussed in the previous lecture how it is originated. In the 1920s, the American chemical and manufacturing giant big company DuPont Corporation created an internal management tool to better understand where its operating efficiency was coming from and where it was falling short. By breaking down return on equity into a more complex equation, DuPont analysis shows the causes of shifts in this number. We have discussed these formulas. DuPont analysis is equal to net profit margin into asset turnover into equity multiplier, and how to calculate we have seen in the previous lecture. Uh, what are the uses of DuPont analysis we have seen, and we have we have uh, discussed with taking the two companies, Super Company and Gear International, and we have analyzed the numbers of these two companies and compare that the how return on equity is getting or it is generated. Example we have seen and analyzed, a real life example we have taken in the previous lecture, Walmart store, and its number we have taken and calculated DuPont analysis. What DuPont analysis tells us, that is operational efficiency, operating efficiency, net profit margin, asset turnover and leverage, and how to compare it, and which component gives operational operating efficiency, net profit margin and asset leverage we have seen in the previous lecture. uh, DuPont analysis versus return on equity we have discussed. Now in this lecture I'm going to discuss with you, we are going to discuss that is DuPont analysis components. DuPont analysis breaks return on equity into its constituents component to determine which of these factors are most responsible for changes in the return on equity. The first one is net profit margin. The net profit margin is the ratio of bottom line profits compared to total revenue or total sales. This is one of the most basic measure of profitability. One way to think about the net margin is to imagine a store that sells a single product for $1. After the cost associated with buying inventory, maintaining a location or rent, paying employees, taxes, interest and other expenses, the store owner keeps dollar 0.15 in profit from each unit sold. That means the owner's profit margin is 15%, which can be calculated as follows. Profit margin is equal to net income divided by revenue. So net income is dollar 0.15 divided by dollar 1 is equal to 15%. The profit margin can be improved if cost for the owner were reduced or if prices were raised, which can have a large impact on return on equity. This is one of the reasons that a company's stock will experience high level of volatility when management makes a change to its guidance for future margins, cost and prices. Next component is asset turnover ratio. The asset turnover ratio measures how efficiently a company uses its asset to generate revenue. Imagine a company had $100 of assets and it made $1,000 of total revenue last year. The assets generated 10 times their value in total revenue, which is the same as the asset turnover ratio and can be calculated as uh, asset turnover ratio is equal to revenue divided by average asset is equal to dollar 1000 divided by dollar 100 is equal to 10. A normal asset turnover ratio will vary from one industry group to another. For example, a discount retailer or a grocery store will generate a lot of revenue from its asset with a small margin, which will make the asset turnover ratio very large. On the other hand, a utility company owns very expensive fixed asset relative to its revenue, which will result in an asset turnover ratio that is much lower than that of a retail firm. The ratio can be helpful when comparing two companies that are very similar because average assets include components like inventory. Changes in this ratio can signal that sales are slowing down or speeding up earlier than it would show up in other financial measures. If a company's asset turnover rises, its return on equity will improve. Next component of DuPont analysis is financial leverage. Financial leverage or the equity multiplier is an indirect analysis of a company's use of debt to finance its assets. For example, assume a company has a dollar 1000 of assets and a dollar 250 of owner's equity. The balance sheet equation will tell you that the company also has dollar 715 debts, that is asset minus liabilities is equal to equity. If the company borrows more to purchase assets, the ratio will continue to rise. The accounts used to calculate financial leverage are both on the balance sheet. So analyst will divide average assets by average equity rather than the balance at the end of the period as follows. So financial leverage is equal to average assets divided by average equity is equal to, in our example, dollar 1000 divided by dollar 250 is equal to 4. Most companies should use debt with equity to fund operations and growth. Not using any leverage could put the company at a disadvantage compared with its peers or competitors. However, using too much debt in order to increase the financial leverage ratio and therefore increase return on equity can create disproportionate risks. This was the these were the DuPont analysis components. That is, first we have discussed the profit margin, second was asset turnover ratio, and last one was financial leverage. And with the help of these three components, we can calculate DuPont analysis formula and find out financial leverage. Now, what are the limitations of using DuPont analysis? While DuPont analysis can be a very helpful tool for managers, analysts, and investors, it is not without its weaknesses also. The expensive nature of the DuPont equations means that it requires several inputs. As with any calculation, the results are only as good as the accuracy of the input. So how input we get the DuPont equations are depend on that, and the results will be according to that. DuPont analysis utilizes data from a company's income statement and balance sheet, some of which may not be entirely accurate. So inherent problems or inherent mistakes, inherent number manipulation or data manipulation mistakes can be come into DuPont analysis, because DuPont analysis uses or utilizes data from company's income statement, balance sheet, or some other statements, that is cash flow and other free cash flow, etc., some of which may not be entirely accurate. Even if the data used for calculations are reliable, there are still additional potential problems, such as the difficulty of determining the relative values of ratios as good or bad compared to the industry norms. Seasonal factors are there, so depending on the industry can also be an important consideration. For example, one season is good for one firm or company, and other season or time period is good for other company. So seasonal factors depending on the industry can also be an important consideration, since these factors can resort or change in the ratios. Some companies always carry a higher level of inventory at a certain time of the year. For example, different accounting practices between companies can also make accurate comparison difficult. So the nature and business environment of two firms may be a different one, and the income statement, that is different indicators such as balance sheet, income statements may be different for two different companies, and this can be inherently get into the DuPont analysis, and the accurate comparison can be a difficult one. So friends, that were the components of DuPont analysis and limitations of DuPont analysis. Thanks for watching. See you in the next lecture. If you have any questions, queries, or anything, you can contact me. Write your name in the comment box. See you in the next lecture.